Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, last week we discussed if this is the right time for you to book profit, and today we look to answer another very commonly asked question during market peaks, which is, should you wait to buy the dip? Now, the markets are at their all-time high, and a lot of investors want to know if they should be investing systematically through these market highs, or should they, keep some cash in reserve and look to buy the dip. That's exactly what we'll answer today. Welcome, Dhirendra.
Thank you.
First of all, let's tell our viewers, are the markets expensive right now?
It is impossible to guess whether the market is expensive or cheap, simply because it's a very dynamic situation. If companies are earning 100 rupee and stock prices are at 1000 rupee, tomorrow if companies start earning or they grow their earnings to 150 rupee, then it might look cheap by hindsight. So you don't know. If companies' earnings dip, then the market might be very expensive. The markets might be very expensive if the company's earnings will go down and go down for a prolonged period of time for a variety of reasons. Saying that whether the market is cheap or expensive will amount to being an astrologer. You will have to guess that the company's earnings will grow, or people will stop investing, or people will book profit and will not come back to market for a while. And no investor has any control on all this. I think companies are poised for growth. Companies' earnings is growing rapidly, and even if investors, there are two things which drives the market. One is the corporate earnings for equities, and the other is investor sentiment. And there I feel that the investor sentiment, and particularly the domestic investor sentiment, has turned around and is zooming and booming in a manner, and in a very methodical manner, that I don't see that vaporizing. So I would say that markets might be expensive, may be cheap, and it is worthless to guess that. Stick to your plan, make a plan, have some cash, have some 10, 15, 20% cash, so that if you get lucky with a dip, by all means, benefit from it. Whether the market is expensive or cheap, you will get to know only with hindsight. After the market has gone up and after the earnings are out, then you will get a sense that, okay, yes, the markets were expensive or cheap.
Okay, so you're saying keep some cash, but should the investors stop their SIPs and keep that cash for when the markets will dip, they will invest then?
Oh, with your SIP, don't fiddle with your SIP. You should fiddle with, a part of your money. But SIP is something, if you are investing for 10 years, if the market is expensive and even if it comes down temporarily for a period after a year or so, how does it matter? Because you will be holding it for 10 years. You'll be okay. Only some part of your money will be going at a level which might look attractive. But there is a great possibility that you will miss an opportunity. Not only that, I think there is a great value of an investor's discipline. Because most of the time, investors profit not because they invested money or they picked a great investment or they picked a great fund or a security, but it's entirely because they were disciplined. They invested through the lean times. They invested through the good times. They actually made sure that they were investing regularly. They made sure that, they were able to grow their savings and investments year after year. That, I think, is the magical thing. So if anything which distracts you from that disciplined strategy, don't even consider that. So maybe have 5, 10%, 15% or some meaningful amount which you think is useful. But otherwise, don't even think of timing your SIP investment.
Okay, all of that is fine. But do you think it is possible to, buy at the lows and sell at peak consistently?
Impossible. If that will be the case, then there are fund managers who actually make a living out of it. Their whole career and life and education, they're educated and they are configured to
Precisely do that.
And none of them attempt to do that. In fact, I have seen that most fund managers, whenever they have tried to do that, they have gone wrong, or they have been caught on the wrong foot. And they have been caught on the wrong foot in a manner that many of them actually lost jobs. In fact, I remember in 2004, there was a very unusual thing. The government changed and everybody was expecting the NDA government. And the NDA government was not re-elected. and the market fell by 16%. And there were people who were actually keeping substantially in cash, many fund managers, nearly a third of their money in cash. And they looked like a winner. That okay, they were unable to, they were able to call it right. And what happened thereafter was the market zoomed like anything in the next couple of days. So what was cash, which was actually looking very, profitable or beneficial to them for a couple of days, it turned out to be one of the greatest disadvantages. So people being in cash and the market had one of the biggest run-up after a few days of an unexpected election result. Translated. So anything can go wrong. These things are not in your control. My suggestion to all investors at all times is control what you can manage, what is in your hand. What is in your hand is how much can you save, how much can you invest, how much can you actually take out of it just in case you need the money. Have these plans. When do you need the money? Maybe that part of your plan is negotiable. Maybe you need some money which is after 5 years from now. But maybe if it is postponed for another 2 years, it won't really hamper your plans. There are plans which will heavily depend on having a defined amount of money at a given date. They are non-negotiable. So I think plan for all those things very well. Do your budget every month and see how much can you save more. Can you really invest a little more? Because in the early stages, these habits are extremely beneficial. Once you are able to accumulate and build something worthwhile, then accumulation, then you can actually play around with a part of your money. But initial days, just form a habit, develop build that discipline. And all these things which you are asking, that should be time it, should it be expensive, is it cheap, is a distraction, is the noise, and it will always look like you'll benefit a lot. And basically,
it's impossible to do.
Yeah, it's impossible to do that. And even if you succeed, it will be a random thing.
Right.
It'll just be luck.
And falling into that habit is going to be dangerous.
Itself will distract you.
All right, then don't disrupt your SIPs. Continue with them, but yes, having some amount of cash to leverage during such
special
times.
situations. Yeah.
Before we end this episode, we'd like to answer a viewer question, and Vivek Bhatt asks, "Can we do lump sum investment in mutual funds now? What would be better if one has to do that? A balanced advantage fund or a flexi cap fund?"
It depends what is that scale of lump sum investment. If that scale of that lump sum investment is 3 months of your income, you can well do it. If that scale of investment, that lump sum investment happens to be 5 years of your earnings, never do that. Spread it over next 12 months, spread it over next 18 months, because any interim correction, any interim decline in value will be very upsetting. It will scare you, and that might derail you from your long-term plan. So depends what is the scale of lump sum, number one. Number two, balanced advantage or flexi cap fund. If this money is for 10 years and more, flexi cap. Do your SIP, substantial money. And if this money is for 3-4 years, then balanced advantage. Simply because it is a steadier take on growth. The worst case scenario in a big declining phase is not as much fall as a flexi cap. So shorter term balanced advantage, longer term flexi cap. But there's one more thing to it, that in the balanced advantage category, you don't have too many credible options. So you have very few, though there are many balanced advantage funds, but only some of them are worth investing.
And they can come to value research to know which those funds are.
Discover it more.
All right then, hopefully Vivek, you've got your answer. Keep watching this space for more information. Keep those questions coming. We'll be taking them up in the subsequent episodes. And if you like the show, do subscribe to our YouTube channel. Take care. Bye for now.